You know, you have this tremendous sell-off that we've seen, and it's ahead of the weekend. If you were lucky enough to be short, I think you're going to cover ahead of this going into the weekend. You might as well take your profits. I think ultimately we're not out of the woods yet, but it's definitely healthy not to make a new low the Friday before the weekend is my initial thought on the action today.
Jack, looks like you say it's a standard healthy correction. What does that mean about where we go from here?
I think we're pretty typical in this sense of this correction, where we're seeing a lot of selling, a little bit of fear. Maybe it goes another 1 or 2% on the lower end, so we're very close to the bottom. But I think we're going into an avalanche of corporate earnings. We're going to see over the next 5-6 weeks all the companies reporting, and that's really going to set the tone for this market for the balance of the year and into 2019.
Rick, obviously the narrative for this week, and actually for a couple of weeks, has been somehow pointing to the bond market as the catalyst for a lot of this kind of upset in the stock market. But, you know, as you've been pointing out, bond market's been kind of methodical in what it's been doing, and actually yields a little bit lower today across much of the curve. So what do you think the actual story the bond market is telling here?
Is that rates are going up, and we could debate the calendar event of that, but they're going up. And they're going up in a way that it really isn't as threatening as many think. Certainly when we went through 311, Mike, that was a big deal, and it got momentum, and we haven't looked back since, whether it's 311 on 10s or right around 3 1/4 on 30s. The whole curve is trying to come back and retest those breakout levels from basically the third week in September. What I read into that is that rates are going to be firm, and they're going to be very stingy about the reciprocal kind of unwritten agreement that rates give back a little when stock market gives back a little or a lot. That because they never even reached double-digit basis point retreats from the high yields, which, by the way, were exactly 1 week ago, Friday at 323 in 10s and 340 in 30s. The dollar index also figures in. It really feels spongy, but it's doing okay, especially in the context. If you were to erase some of those 2-week periods in August during emerging market volatility, that would change the whole look. You don't think the dollar index is performing well? Look at where it was in April. Ultimately, I think the curve steepening a bit tells me that the economy was doing well. The fact that it flattened a little bit during all this volatility tells me the most important information, Mike, that the notion of the Fed easing up anytime soon is certainly not built into the marketplace at this point.
What about the Fed unwinding its balance sheet? You know, I know Rick is well steeped in the knowledge here, but we haven't talked about it. Rick, we're up to $50 billion per month now, and you see the effect.
This is the tightening, quantitative.
Yeah, quantitative tightening. So people are talking about rates, but you also have, at the same time, them unwinding the balance sheet. So whether or not you have a debate on rates, why not do one or the other at one time? It's twice as much now.
Well, can I just throw the banks into this conversation?
Steve, let me just jump in here. The problem is that the balance sheet is such a unique animal when you consider that it's just recently dipped under 16 trillion cumulatively for all central banks, that I think Ben Bernanke and Janet Yellen tried to ponder. Try to keep that as orderly and on a very predictable trajectory, and let's see how it goes. They may use that more as a tool in a year or two. I just don't see them really kind of touching that area as much sense as what you say makes. And the other issue
the problem is
that
though, Rick, is that 13 central banks. The problem is that 13 central banks are simultaneously tightening at this point. Yes. So I get what you're saying. We all want to get to more normal markets, but there's a lot of moving parts here that are all happening at the same time.
At the same time. Yep.
So, Jack, why aren't banks up? I mean, you've got higher rates. Rick says they're going higher. You've got tightening, you know, better economy. And the results today weren't that bad. JP Morgan, Citigroup.
Well,
maybe something that we can ask Wells Fargo CFO about this as well, but it's the worst performing group right now in the sector, in the S&P.
I'm a big believer that the market anticipates. We had a 50 to 100% move in most of the larger banks last year. So they were anticipating this very strong economy, this expected rise in interest rates, and now we're actually seeing these rise in interest rates. So the market's trying to make a bet. And the bet is basically that we're maybe halfway or 2/3 of the way through the peak of the economic cycle. These are cyclical companies, so the market may be right, they may be wrong, but I think that's one of the reasons why the banks have not performed all that well, despite the fact that earnings are doing very good.
I think a lot of people would take half or 2/3 of the way through the cycle. Seems to me the market's really sensitive to the idea that we're even later than that. So that would be probably a benefit.
Well, it'll be interesting to see if they actually show a lot of strength going into 2019. The corporate profits are certainly going to be good. The economy's in great shape. It sort of gives the environment for another leg up for the banks.
Did you take the opportunity of the big drop this week in Amazon to buy more? I know you like that one.
Well, we are involved in Amazon for quite some time. We invest in thematics, so we happen to like the whole internet backbone strategy. There's only a few companies that you can really invest in that are critical variables for the backbone of the internet. Those are Amazon, Microsoft, and companies such as Alibaba in the international markets.